Holy shit, ladies and gentlemen, we have some breaking news. Fitch downgrades the U.S. long-term rating to AA from AAA. Last time we had a downgrade in the markets, the S&P fell 6.5% the following day. So, yeah, I'm pretty sure this is not good. So let's go ahead and get into all of the implications, what this could do for the markets, how it could affect your portfolio, and how to potentially prepare. Now, the best way to prepare if you want to come hedge your portfolio, hopefully make a ton of money, link down below in the description of this video to join the trading community. If you don't want to do that, well, there's other things you could do, right? You can hedge your portfolio in a lot of different ways. Now, let's go ahead and get straight into it. So, Fitch downgraded the U.S. What they said was, quote, expected fiscal deterioration over the next 3 years, an erosion of governments, and a growing general debt burden. The repeated debt limit, political standoffs, and last-minute resolutions have eroded confidence in fiscal management, said Fitch. In May, the agency placed the nation's AAA rating on negative watch, blaming the debt ceiling fight. At the time, lawmakers in Washington butted heads over an agreement that would keep the federal government from running out of money. President Joe Biden signed the debt ceiling bill on June 2nd, just days away from the X-date on June 5th. The country's recent debt limit feud was mentioned again in Tuesday's downgrade. Quote, in Fitch's view, there has been a steady deterioration in standards of governance over the last 20 years, including on fiscal and debt matters, notwithstanding the June bipartisan agreement to suspend the debt limit until January 2025, the rating agency said. Fitch also highlighted the rising general government deficit, which it anticipates will rise to 6.3% of domestic product in 2023 from 3.7% in 2022. Cuts to non-defense discretionary spending, 15% of total federal spending, as agreed in the Fiscal Responsibility Act, offer only a modest improvement to the medium-term fiscal outlook, Fitch said. The agency also noted that a combination of tightening credit conditions, weakening business investment, and a slowdown in consumption could lead the economy into a mild recession in the fourth quarter of 2023 and first quarter of next year. The White House disagrees with Fitch's downgrade. It defies reality to downgrade the United States at a moment when President Biden has delivered the strongest recovery of any major economy in the world, Press Secretary Karine Jean-Pierre has said. This isn't the first time a rating agency has downgraded the U.S. Standard & Poor's cut the nation's credit rating to AA from AAA in 2011 after Washington managed to avoid a debt default. At the time, the agency highlighted political risk as part of its reasoning. If we go back to the Internet archives and take a look back in history, back on August 6th, 2011, S&P downgraded the U.S. credit rating. So there's 3 credit agencies. There's S&P, there's Standard & Poor's, and there is Moody's. Now, we've seen downgrades from S&P and now Fitch. Both of them took the U.S. credit rating from AAA plus or AAA to AA plus. Moody's is the only one that has not downgraded the U.S. credit rating. Last time S&P downgraded the U.S. credit rating in 2011, they never raised it, so it's still downgraded. And this caused markets to sell off 6.5% the next day. Now, what S&P said at the time is that the U.S. fell short. The downgrade reflects our opinion that the plan that Congress and the administration recently agreed to falls short of what, in our view, would be necessary to stabilize the government's medium-term debt dynamics. This has only gotten worse since then. Now, markets are in a different place than where they were before. That is true. Markets are almost at all-time highs. Back in 2011, that was not so much the case. A lot of people were fearing the double dip recession after the global financial crisis. There was, again, the debt problem that a lot of people were fearing. And back in 2011, we actually had to pay a lot more in interest because of this downgrade, because of the government's inability to come to an agreement. So there were things that were going on in the meantime. And we had got put on a negative watch, which is what Fitch did back in May for a potential downgrade. So that was another thing that was kind of affecting the markets at the same time. And during this crash was somewhat getting priced in. But again, you got downgraded on August 6th. And the next trading day on August 8th, which was a Monday, right? You got downgraded Friday after hours, started trading Monday, and the markets fell 6.5%. Now, at the time of recording this video, futures are down about 0.5% for the NASDAQ. So I don't know exactly what's going to happen here. Obviously, I don't have a crystal ball, but what you really want to watch is bond yields. This could drive investors to sell bonds. Selling of bonds drives the yields higher. So if the yields do go higher, based on this, that does a couple of things. It increases the odds of a recession, which is bearish. It increases the cost of capital because you're competing with bonds anytime you want to get capital. For an example, back in 2020 and really up until 2022, bonds were at 1% or under that, at 0.5% during 2020. You would have lent out your money for you or me or really anyone for a mortgage at 2%. That's why you had 2% mortgages. Hopefully you took advantage of that at the time. But that was because you didn't have anywhere else to put your money. Well, now when 10-year treasuries are 4%, you're not lending out your money for a mortgage till you have 6.5%, 7% or more if you're a subprime borrower. So it increases the cost of capital and it makes capital less available and less accessible. Have you tried to get a car or a house recently? It's a lot more expensive on a monthly payment for the same amount that you are borrowing because of that interest cost. And it's all around the bond yields, specifically around this 10-year bond yield. Now, what's been happening recently, ever since about April, is the 10-year treasury has climbed from 3.28%, about 75 basis points, now at 4.02%. If this starts to break out past the highs that you've seen in October of 2022, coincidentally when the markets were crashing and hitting their lows, well, you could have a problem. That highest yield that you've seen on October 20th was 4.22%. So if you start to break out of that level, you're going to get a lot more fear and panic in the markets. Now, I think the markets are waiting for Amazon and Apple earnings. Earnings season so far has been decent. It hasn't been great, but it hasn't been terrible. So I think markets are waiting for these earnings. Amazon and Apple report earnings Thursday and after hours. For context here, Apple and its market cap is over $3 trillion, as you guys know. That's larger than the entire Russell index, just with this company. So Apple's expecting to see the worst drop in iPhone revenue since 2016. So it's not like expectations are high that we're going to see good earnings. Like, that's not what's going on. But if they're worse than expectations, you're going to be in for a problem. Same thing with Amazon, because that's kind of a bellwether towards the economy. Now, there is a positive out of this downgrade at the same time. And one big thing that is different now than what you've seen in 2011. During 2011 and this moment in time, the Fed was not raising rates. So this just increased the odds of a recession quite a bit. So there's a very valid argument that maybe the Fed will not raise rates anymore. And that would be the positive in this situation. And if there was anything markets would grasp onto that is positive, it would be that. No more Fed rate hikes after this downgrade from Fitch. Historically speaking, the Fed has never cut rates until the VIX was over 40. So you kind of need to see fear come back into the markets to get a rate cut at least. But it might mean no more rate hikes. And I think still the biggest catalyst for the markets is going to be Apple and Amazon earnings later in this week. But you also want to watch the bond auctions. What you have seen recently, the red day that we had last week where the S&P and the Nasdaq kind of just nosedived the last half of the day. This was on July 27th. This happened because basically nobody showed up to the bond auction. Bond yields jumped dramatically because just nobody showed up. Nobody wanted to buy the 7-year bonds last week. And the rates, we can actually go ahead. Previous week. We can actually go ahead and look at that for you. That was on Thursday. And you have it right here. The previous bond auction last week, and this is what caused the markets to fall, was 3.83%. You were expecting somewhere around 3.8% to 3.5%, 3.85%. Yields came in at 4.09%, about 29 basis points higher than expectations. So if you start to see people not showing up to these bond auctions and letting the yields go, higher and higher, that could be a cause for concern for our markets. Now, tomorrow you're going to have a 17-week bond auction, and that's going to be really the only bond auction tomorrow. And then on Thursday, you're going to get more bond auctions, and that will obviously affect the markets really on Thursday before you get Apple and Amazon earnings. So long story short, I don't know exactly what this will do for the markets. Times are a little bit different now than they were then, but either way you want to put it, it's not a positive. And I think that's the bottom line. Even if you don't get a 6.5% down move tomorrow, you're not going to be out of, in the clear, maybe I should say, for quite a while, and it probably leads to a pretty rough August at the very least. So that is going to do it for this video. Hit that like button, subscribe to the channel, and source your comments, questions, or concerns down below in the comment section. Thank you for watching, and enjoy the rest of your day, and I will see you in the next one.